This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, a devastating blow is about to hit this sector of the U.S. economy. And I want you to understand that why this time it's different and that this sector is going to drag down the entire U.S. economy with it. And you might be surprised to find out that there's another expert I agree with. Stay tuned to find out who it is and why. Plus, we have a sponsor for today's show. You might remember Bryn Miller Energy. Well, they're back and with some big news. You can find them on the NASDAQ under the symbol BNRG. I'm going to show you based on their chart setup and what's going on with this company, why their stock could make a quick 9% move to the upside with a potential of an 18% move or more. Check out the pinned comment or description for more information. Now, let's head over to Bloomberg because I want to set up today's story from a demand perspective, and it's critical that you understand this. In the headline, Citigroup offers partial early bonuses to get this to encourage staff departures. Now, we hear from the Fed that they want to see a slowdown in the U.S. labor market because, in their opinion, it is strong and robust and they want it to cool off a bit. So as we look around, it's actually expected that we should actually see some layoffs here. The problem is where they're coming from is not exactly what the Fed expects. The New York-based lender has already cut more than 300 senior manager roles as part of the upcoming revamp, and those are part of a wider staff cull that is expected to continue into 2024, though the company has yet to put a figure on the ultimate number of job cuts. And what I want you to understand is in a booming economy, if indeed we're going to experience a soft landing, and Citibank thought that perhaps there's going to be a lot of demand coming forward, there's no reason why they would want to get rid of employees. They might do some restructuring, they might cut some hours, but they're going to go forward thinking that perhaps we're going to need all of the experience and talent we have because there's going to be a huge surge in lending. The problem is there's not. And here you can see this from last week. The commercial industrial lending data on a weekly basis is in contraction at minus 0.7%. And what that means is we are seeing less loans being created. In fact, there's so few loans being created that it's actually leading to a destruction of money now. So as we see a contraction of commercial industrial lending, we don't need as many bankers to originate these loans. But again, the challenge in a debt-based economy is new money is created with the origination of a new loan. So when you see a contraction here, it means money's being destroyed on top of the fact that we're seeing financial conditions from the banks at relatively tight levels. This does not bode well for a soft landing at all. And as we look forward, Pfizer falls to the lowest in 10 years. Get this, on disappointing forecast. So you'll notice the change in the headlines here that all of a sudden you're starting to get the picture that demand is indeed shrinking here. Let's take a look at what's going on with Pfizer because they're not the only one as they saw their shares tumble to the lowest level in a decade after its disappointing forecast for the next year showed a purchase of its leading cancer drug maker isn't enough to fill the ever-growing hole from its flailing COVID franchise. So again, what does this lead to? Fewer employees, less demand, less employees, and it all starts to snowball. So as you start to see the setup here of where this is going, well, again, they're not the only ones because here we are in the Ford factory because they're planning cuts to their 2024 production of its electric F-150 Lightning by as much as half. Now you think back to the pandemic when people were just flooded with money. And remember, the economy was closed. People really couldn't go anywhere. And yet what did many people do? They went out and bought brand new cars, parked them in their driveway or their garages, let them depreciate, but they had the money to make the payment. They just didn't drive them. So if you start to think again, from the economy as a demand perspective, what are we seeing? Demand declining across the board because if the economy was indeed booming, as many of these political elites suggest, well, Ford shouldn't have any problem selling trucks. And we'll continue to match production with customer demand, which is clearly down. And Ford executives have recently said the automaker will match production to demand as the company cancels or postpones $12 billion in upcoming EV investments. So all this suggests is, as we know, that as you cut investment into future projects, guess what you need is less workers. And as you take workers out of the economy, well, it has a devastating effect across the board. But just because you're seeing cuts in some companies as demand falls, well, what we're seeing is demand increase in others, such as our sponsor, Miller Energy. They are doing carbon-free thermal energy storage. Again, you can find them on the NASDAQ under the symbol BNRG. Let me show you their setup here, because they've been selected as the preferred solution for Spain-based Cadiz project designed to produce 29,000 tons of green e-methanol energy annually. And this is a big deal because I think their technology is going to spread like wildfire. And you can see why here, because this integrated system will be operated with wind and solar to produce 220 megawatts of electricity completely off grid, and something we think is going to go just shooting higher as their stock price. Here you can see it sitting in the supply zone, again, under the symbol BNRG on the NASDAQ. See that horizontal red line? That is the volume profile line over the last 5 days, showing where buyers are at. It made a recent move up here. That would be a 9% move if it happened again, with the potential to get all the way back up into the overhead supply zone. That would be an 18% move. So again, you can see that some companies demand is going down, but other companies demand is rising. But yet there's another space of the economy that says maybe demand overall isn't that great. As oil hovers near 5-month lows amid mounting oversupply signals, and here we can see that Russian seaborne exports rose to their highest since early July, and yet OPEC continues to project supply shortfalls for the first quarter as they scratch their heads and wonder, why won't price go up? Because we've talked about, you can constrict supply all you want, but in the end of the day, prices of energy need to come down, demand will fall. If you want energy prices to rise, you've got to have the economy growing. So oil is giving us a wonderful leading indicator of where the economy's headed. And throughout the past few weeks, key market gauges have signaled supply continues to outpace global demand. And again, that's not what you see when you talk about a soft landing. And that's why, as we get into our lead story and talk about how the sector is going to get just crushed, it's going to drag down the rest of the economy, because what you're seeing across the board is strictly a decline in demand. And there's only so long before employers will end up laying off. And nearby contracts are trading below those with later date, a bearish structure known as contango, and some spreads are about the weakest since late 2020. And as we mentioned, the weekly average of Russian seaborne crude exports jumped to the highest level since early July, while the U.S. raised its estimate for output up for this year. And here you can see, even though crude oil inventories dropped this past week by 4.3 million barrels, look at this, distillate stocks, this feeds into jet fuel, that's up almost 1.5 million barrels, and gasoline inventories, after that massive build of 5.4 million barrels last week, still managed to increase by 400,000 barrels this week. So you look at the fact that demand across the board is declining. And if you're wondering, how do I have an opportunity if this rebounds? Well, we'll show you in our reports. We got our CTA Timer Pro report. This is from today. On a historical basis, crude oil, according to the machines, max short. You want to know how to make money in crude? Sign up for our report. Wait till the indicators flip, and that gives you the signal. You like trading the technicals on the other side? Our Momentum Timer Pro, 6 consecutive daily sell signals. It's been telling you, get out of the energy sector, and both reports will tell you when to get in. Again, check out the description for more information. There's 3 coupon codes for a free month for each, plus all the information on Miller is there too. So let's get into our headline story. As U.S. producer price inflation cools below 1% as energy slides. Now, this is a devastating effect for the manufacturing sector, because I want you to look at this from demand. That's why we set the show up this way, is to show you if demand goes down, well, production eventually follows. But what is the issue that we've been hearing from all these political leads about the labor market is that at some point, prices are going to come down, but wages are going to stay up. But maybe they're not. The U.S. producer price gain slowed in November as energy costs declined, adding to signs that inflation pressures are abating. Now, this is a good thing. The producer price index for final demand was unchanged for a month earlier, so it's completely flatlined here. So if you talk about the idea that companies are going to be able to continue to support higher wages or more hours worked, don't they actually think about it? They need more production. They need prices to go up to support it. Because when a company comes out and raises prices and they give out these big raises, well, they still need to increase their price to absorb that and get their margins back where they want. So that way, of course, Wall Street's happy and everybody's happy about buying their stock. The problem is what they're seeing is demand flatline here. That doesn't bode well for at least where the economy's going. Maybe it helps the Fed. Excluding food and energy, the so-called core PPI was also flat, and from a year ago, the overall measure was up 0.9% in its big slowdown, while the core gauge was up 2%, both the least since January 2021. And even services sector, which we heard should be driving the economy, prices there were unchanged for the second straight month. So here we're seeing both on the manufacturing side and the services side, a flat lining of producer prices, telling us that any notion there's going to be big wage increases in the future, well, those hopes should be dashed. As good prices were also unchanged after a steep decline in October, energy costs driving this fell 1.2% last month, even though you remember the survey said that consumers thought energy prices were headed higher. We said, nope, no chance, they're headed lower. And let's talk about what this all means for not just consumer prices, but for this entire sector, and then the rest of the economy. Here you can see producer price index by commodity for final demand in blue against the consumer price index, that in red, both on the year-over-year rate of change. And you can see that where producer prices go, consumer prices follow, because consumer prices do not stay elevated if they're coming out of the factory without big increases. And sure enough, this means that the Fed is likely to see us head toward their target here in the next couple of months, and that would mean an end to the rate hike cycle. In fact, we'd be more likely to talk about cutting rates far sooner than Fed chief thinks. But if we continue looking at producer prices, of course, we need them to rise to support higher wages because consumers are still gripping with inflation, now showing average hourly earnings of production and non-supervisory employees multiplied by the average weekly hours for the manufacturing sector. So here you can see the producer price index comes down in blue. And what does that mean for total compensation in red? Well, it means the growth rate slows down. You see it here again during what was almost a global recession. Producer prices went negative. Well, and employment total compensation, that slowed as well. You can see it going into the pandemic. And now everyone's stemming their hopes that wages are going to continue to rise, but they can't. That's the issue, is if producers do not have more money, more margin, they cannot pass on higher wages. Eventually, as you're about to see, that's going to lead to more unemployment. And as the manufacturing sector goes, well, you wait till you see. It's going to take everything down with it, because as I started to show out with today, that is this time, it is indeed different. And here you can see the producer price index again shown in blue against the non-farm private payroll employment for the manufacturing sector. And you can see coming back here 2015, 2016 during that global slowdown, what happened to employment in that sector? Well, it stayed relatively flat. But now look, as we see it coming down, again going to the pandemic, what happened is slow down. This time they laid off. And here again, we're seeing layoffs again in the manufacturing sector. They're just not convinced demand is there. And that should feed into what we're seeing in the 4-week moving average of initial claims, which we watch very closely every week. Because here again, you see a slowdown in the producer price index. What happens? The initial claims data flatlines. You see that again in 2015, 2016. You see that again going into the pandemic, and you're seeing it now. And so despite the fact that everyone thinks the labor market is strong, as long as the manufacturing sector continues to lay off, we should not see much downward pressure on these initial claims. But what makes it different this time is continuing claims. If you look back now, you see here in 2012 what happened. Producer prices slowed down, and what notably happened is continued claims decline, suggesting that as people from the manufacturing sector lost their jobs, they were absorbed elsewhere. We saw that again in 2015, 2016, evidence showing that indeed the economy was robust enough to hold up against this slowdown, as well as 2019 into 2020. But look at this time. You're seeing a decline in producer prices, and people that are on continuing claims, well, that is rising, suggesting that, again, this time it is indeed different. But of course, as we know, the Fed doesn't see it. We know that they're pausing today, not likely to have an increase at all again, because this time the economy is indeed not set up for any type of soft landing at all. The Fed isn't ready to speculate on rate cuts, but yet I'm going to show you who is here in a moment, why, and why I agree with them. Powell said it's too early to speculate on when the central bank will start reducing interest rates. Instead, policymakers have emphasized their desire to pause and evaluate the impact of higher borrowing costs on the economy, but there's absolutely no way they're going to suggest that they are taking rate hikes off the table, because they've been talking rates up so much and that they believe that inflation's coming back. And that's why I showed you the producer price index is telling us very clearly we're not going to see a resurgence in consumer prices unless we see producer prices rise. And yet, despite the fact the Fed can't see it, the bond market can. As blistering Treasury rally silences the deficit-obsessed vigilantes. Now remember, everyone was saying interest rates have to rise because there was so much debt issuance. We said, well, you know what? That's not actually how it works at all, but many people believe. And then almost as quickly as they rose, yields plunged and all the way back down near 4%, this referring to the 10-year. So what happened to the all-hand writing about the reckless government spending and the ballooning of national debt? Well, sure, the bond rally was sparked by a different development. Speculation the Federal Reserve will start cutting interest rates next year. But still, the tough vigilante talk disappeared rather abruptly. And that's the reason why, is because when you understand how the economy works, if higher rates do not lead to more demand, they will come down. Not because people buy it, not because the government issues more debt. It's how the monetary system works. Everyone in the world could be short treasuries and yields would still fall. And so when we come back to this demand issue, we come back to producer prices. Here you see all the evidence you need that indeed the economy is slowing and rates need to fall to spur demand, because you look back, producer price index goes down, and what happens? Rates come down, and then the producer price index starts to stabilize. You see it happen again in 2015, 2016. Producer prices go negative, and then what happens? Rates come down until they stabilize and demand comes back. You see it going into the pandemic, they were both headed down. This time, everybody's short the bond market as they swear that interest rates must go up because of all the debt issuance, and yet what's happening is the economy is continuing to head down and it's going to enter contraction. And when that happens, of course, we know that rates are going to come crumbling down and all these bond vigilantes are going to get crushed in a big way. And the vigilantes will be back. This according to Yardeni, the founder of Yardeni Research. Well, they can come back and they're going to get smushed because the surge in government spending, he said, in recent years and jump in interest rates is creating a dangerous fiscal mix. This is not an issue that will go away unless it's fixed. If anything, the deficit outlook is probably worse than being anticipated. And yet, Yardeni, you've got it completely wrong, because there's one person here I do agree with. There are plenty of skeptics out there who saw the summer rout in treasuries as something of a one-off event, and prominent in this camp is Stephen Major, a perennial bond bull at HSBC Holdings. And while he acknowledges he didn't anticipate the market impact this year of bond supply increase, he's adamant that over time deficit is a sideshow. He said, quote, supply can have a short-term impact when there's an imbalance with demand. But over the longer run, it's not the main driver of bond yields. Indeed, it is growth and inflation expectations. Both of those, as you can see, are headed much further down. And with that, be sure to remember, like any sponsor we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.